The moment a vertical trend is verified by the price action, executing an entry becomes an exercise in mathematical risk management. Traders often enter in the direction of the trend, only to face an immediate, sharp reversal that erodes their account balance. This initial move, known as Wave A, represents pure connect displacement, an expansion phase that rapidly consumes institutional fuel. Chasing this vertical exhaustion requires guessing the downside risk. Because the move has already detached from its origin, the position lacks a logical structural floor. Entering late in the expansion aligns the retail trade with the specific window where institutions pause their buying to harvest profits. Corrective price action following a major trend serves a mechanical function. This specific phase, known as the Wave B era, operates exactly like a high-performance pit stop in the institutional lifecycle. For institutions to fill massive block orders without suffering severe slippage, they must intentionally allow the price to breathe back down into structural value zones. Retail participants often view pullbacks as a sign of weakness or a loss of interest. Professional algorithms view them as the only environment capable of providing the volume needed for reaccumulation. While breakouts provide the initial map, the pullback offers the structural geometry required to calculate a sound entry. This chart shows the transition into Wave B. Directional buying pauses, and the price slices downward through the 8 EMA, our fastest momentum line. From here, the pullback will develop into one of two distinct structural profiles. In a shallow B pullback, price finds immediate friction at the 21 EMA, representing the short-term fair value of the trend. This indicates a hyper-dominant trend, where algorithms are stepping in early to prevent price from sliding further. Profile 2 requires a more significant shift in sentiment, the deep B showdown. Price slices straight through the 21 EMA and buries itself deep into the defense cloud. It travels down to the final structural boundary, the 55 EMA macro shield. The 55 EMA serves as the primary testing ground for large-scale institutional reaccumulation. The depth of the pullback, whether it holds at the 21 or the 55 EMA, maps the level of institutional back pressure required to sustain the trend. To fill massive long positions at the 55 EMA without driving the price up, institutions must defend the line while inducing others to sell. This creates the liquidation sweep, a deliberate move where the price wicks temporarily below the 55 EMA. This sweep targets retail stop losses and tricks breakout traders into shorting what appears to be a trend reversal. We verify the intent behind this move by looking at the pullback profiler histogram on the subchart. If the histogram holds above the zero line and the price candle closes back above the 55 EMA, the sweep creates the structural footprint of a liquidity trap. This pattern is the opposite of a structural failure, or the broken B. In a failure, the candle closes hard below the 55 EMA, while the histogram cascades across the zero line into opposing colors. This confirms institutional support has completely withdrawn from the asset. Surface-level price movement is designed to be deceptive. Intent is only verified by measuring the order flow pressure via the histogram. The most common execution error is trying to pick the absolute bottom of the liquidation sweep. Instead, the protocol is to wait for the price to reject off the 55 EMA and push back toward the trend. The mechanical green light is a candle that closes cleanly back over the 21 EMA baseline in the macro trend's direction. This synchronization triggers the alignment cross diamond dot, a non-repainting coordinate printing on the chart the moment the candle closes over the 21 EMA. The diamond dot registers that the price has cleared the 21 EMA hurdle, signaling that the reaccumulation phase has transitioned into active trend resumption. The kinetic fuel for the next expansion phase, Wave C, is now engaged. Waiting for the diamond dot transforms the entry from a guess into a rules-based execution. This process addresses the unanchored risk of trading the initial vertical breakout. The Wave B pit stop allows for precision risk engineering. The deep pullback solves the problem of risk location by using the 55 EMA as a definitive boundary. Protective orders are placed strictly a few ticks below the extreme of the 55 EMA wick. If the macro trend fails, the resulting financial loss is confined to the specific distance between the entry trigger and the 55 EMA floor. Profit targets are then mapped as a one-to-one vector extension of the original Wave A move. This structural configuration provides the asymmetry needed for payout ratios of 3-to-1 or higher. While many traders obsess over the speed of the expansion, professionals wait for the structure of the pullback. They wait for the Wave B era to establish the whisk parameters that make a trade viable. Mastering these algorithmic mechanics elevates an operator from price prediction to a process of engineering risk based on established structural laws.